Welcome to the Daily Update. This is Being Prepared Thursday, April 21st, where we'll look at the action in the market today and then see how things look for Friday, April 22nd. And my goodness, what a day. We ended up really opening to the upside. We were up 1.2% in the S&P at one point, only to come back and fill the gap and just keep going as the day went on. And we ended up being down pretty significantly, about 1.5%. So we saw a really big intraday move. If you look at it on a daily chart, not much has really happened. We're just back down into the range that we've been in overall. So we did have the gap higher open, and we actually opened above R2. And as I said, we were up 1.2%. And then right after the first 20 minutes or so, there were two nice little bars drawn in. Well, the first one was really strong, and then we just saw selling pretty much for the rest of the day. There were a few little bumps along the way, but it was decidedly negative, and people are freaking out about it. And you have the perma bears. They're, of course, all ecstatic. What a miserable existence. My goodness. They only get happy when the market goes down, and they've been predicting that things are just going to tank and fall apart forever. And eventually, if you say that, you'll be right. But you might go years and years and years of looking like a fool. Just like with the perma bulls. If you're always optimistic about things, well, eventually you're going to be wrong. And if you always implement this buy the dip strategy, yeah, that will work. But the one time it doesn't can do a lot of damage. Where the approach that I take is more, okay, we have up times, we have down times, we have sideways times, and we can take advantage of any one of those environments. We just need to know what's going on, be able to have a little bit of foresight as to what we think is going to happen next, and then we can implement different strategies on different time frames that take advantage of different market environments. Okay, so the selling just kept going. We went below the daily pivot, and then we finally went negative for the day. Sometimes the unchanged level will act as support. Since we were coming down, trying to fill the gap, you might have thought that, okay, we could have bounced up off of that. Well, we just sliced right through that one and then ended up going negative. We attempted to bounce. We didn't quite get down to R2. And then we bounced a little bit, and then selling resumed again. And then selling continued into the close. My goodness. And then there was very minimal buying going into the close. That might have been some people shoring up short positions because they have to sell to get in, and then they have to buy to get out. And that can bump up prices just a little bit. And we had about a 2.7% intraday move. That is big. It's one thing to be up or down a big percentage point. It's another thing to have your intraday move. But really, overall, we're still not trending. We're still not deciding whether this market is really going to go up or down. The positive side that we saw, it's done a lot of damage to that. And so things are more decidedly negative. But when we finally closed, we were down 1.48%. Volume was above average. This is one of the few days we've seen in a while where we saw above average volume. The technicals, yes, they're more negative. And I'll try to point out some hopeful things as we go through the charts. Inflation and interest rates, those were the big things that happened where it looked like we were going to really go higher. When Tesla came out with some earnings and the futures really turned positive, that helped produce the gap higher. But then the rest of the whole day was just inflation, interest rates, blah, 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 Fed speak, all this other stuff that was going on. And then, of course, all the geopolitical concerns. But right now, it's more focused on the economy, at least as far as the stock market is concerned. So the technicals are negative right now. And the improvements that I've been talking about over the last couple of days, there's a lot of damage done to those. But there are still places of hope. There's always places where you can find hope. And remember, I run all three scenarios at the same time. What's the scenario to go up? What's the scenario to go down? And what's the scenario to go sideways? And we can find bits and pieces of every scenario all the time. The S&P was above its 200-day simple moving average. That looked pretty positive. But then we just went slicing right through that again. We ended up getting below the 50-period moving average, and both of those are probably the most important, or at least because that's what investors focus on, is the 50-200 interaction with each other. Then yesterday we had the 10 to 5 yield curve. That one inverted. Well, that's still inverted. And then we had the 30 to the 5 go inverted after Thursday's session. Are we going to see other yield curves go back inverted again? We don't know. But getting out of this inverted yield curve situation where we're potentially looking at a nice run up after that happens, at least that's on hold for right now. And I'll talk a little bit more about that later on. Tesla did provide a really positive open. And of course, Elon Musk has been in the news big time lately for Twitter, for Tesla, and then SpaceX and all these other things. Fascinating person, even if you disagree with some of his points or you really agree with some of his points. He is an interesting person. And then there's a lot of Fed speak. The chairman gave a speech, and that was taken as more negative. One of the more market friendly, if you will, they call them dovish. People that sit on the Fed, they announced that they're going to retire, and the market's like, oh no, we're losing a friend. We better freak out about that. And then just all the different things that you're hearing about from the Fed seem to point that interest rates are going to keep going up. There was some hope on Thursday that when Chairman Powell gave his speech, that he was going to say, yeah, we think inflation is pretty much peaked out right now. Well, he didn't say that. So the markets didn't like that. And that ended up really causing a fuss in the markets. So that's really kind of the real focal point right now. The economic reports that came out were not real big market movers. We had the Philadelphia Fed index, it decreased. And then the leading economic index, which, as I said yesterday, the market doesn't really pay attention to that because so many factors are known beforehand, so it's not a real surprise. That actually increased a little bit. We are still in a trendless environment, and I'll bring up the ADX and show you that chart. The bias, yes, it is negative. We had a big down day, and the momentum is back to being more negative. So let's go back through and look at this. First, we have sentiment, and we have some new sentiment readings to show here, where we're down at 39, not extreme fear. Yeah, it did decline. And I'm having a little problem with these things updating right now, these charts. You can see over here, and then please don't mind the cursor right there. It says that we were at 39 yesterday, and we're at 39 today. Well, that... I don't know. They're not updating these in a manner that's conducive to when I prepare things for the video. So we then look at the historical chart, and yeah, we're down at 39. Not extreme. Yeah, it's leaning more towards fear, and we kind of have to go with that. The sentiment is more negative right now, but it's not extreme at this point. The VIX advanced on a closing basis, and we're back well above 20, well, 22.6, I think that is. And we really spiked up, but we're still below the moving averages. So if you take this on a static basis above 20, yeah, we're back above 20. If you look at it with how it's acted over the last 50 periods, we're still below the average of the VIX. So we're kind of right in between right now. Here's the VIX of the VIX, which as expected, it did spike up, both on the bar chart and on the line chart. This just measures how volatile is the VIX itself. And then the Ulcer Index, because of the decline, it did go up and we're above the moving average. It had been declining, and that was providing a little bit of the potential positive backdrop. But as of Thursday, this is back to getting higher. That just means fear is increasing. And then this is one of the sentiment reports that comes out once a week, or at least I talk about it once a week. It's the American Association of Individual Investors, and it's the bull-bear ratio index. And this is average everyday investors who every week, and I take part in this survey, or you think the market's going to go up, it's going to be down, it's going to be the same, blah, blah, blah. and they just get a sentiment reading from that. Well, since these folks tend to get things wrong a lot of the time, we use this as an extreme, or when it gets to an extreme, we use this as a contrary indicator. And they were really, really negative a week ago. They had dropped down to below 30. Well, they're still really negative, where we ended up being down at minus 25 right now. I have the little arrow right there. This just shows that individual investors are extremely pessimistic right now. And if you go back and look, and it doesn't always match up perfectly, but when individual investors get extremely pessimistic, a lot of times that marks some kind of a bottom in the market. We saw it really nice back in March. Everything had been coming together, and this was one of the indicators that we used to say, yeah, there's a chance we could go higher. And that's what we did for the last half of March. Then another ratio that we look at are the Ridex bearish funds, which go down or increase in value if things go down, and bullish funds, which increase in value if things go up. And then they take a ratio between the two. When this really spikes up, that means there's an awful lot of fear, and people are more into the bearish mutual funds. And then when it goes down, it just shows that people are more bullish. Well, we did spike up over the past week or so, but we're not necessarily extreme right now. But fear is increasing with these mutual fund investors. Another thing that we look at is this is active asset money managers, like hedge funds and mutual funds that are out there that are actively managed, where the manager's out looking for different investments in different areas. That's opposed to a passive index fund, which is based on the S&P 500 or the Dow or the NASDAQ. This actually uses strategies to get really good returns. And when we're in bear markets, asset managed mutual funds tend to do okay because they have more flexibility, or they do better, okay? Because they have more flexibility in what they can do. Where when we're in a raging bull market, passive funds tend to do better. And that I talk about that in the classes that I teach and kind of compare the two with each other. Well, what this does is every week there's a survey and they ask people, are you increasing your exposure to risk? And when these lines are going up, that means yes. That means they're buying more stocks, because stocks tend to be considered a risk-on approach. When this line is really decreasing, that means these asset managers are getting out of riskier assets and getting into more defensive assets. Well, this was when we hit the bottom back in March, and this produced a nice signal as well, and we really went up. Then when we topped out, they started to take some of their risk off the table. Over this past week, they are increasing that risk just a little bit. Now, this is before the big move on Thursday, so we'll have to see how things adjust. This comes out once a week, and these folks are humans. A lot of these folks, they have to react to what's going on. They're not necessarily geniuses at what they do. Some people are very good at that, but they're human nonetheless, and sometimes they make mistakes. So when everybody is positive, we're looking at a contrary move to the downside. When everybody is negative, we're looking for that move as a potential bounce. All right, the sectors. Every one of the sectors ended up being negative on Thursday. And energy, which has been doing quite well, it was down the most. And then communication, which has not seen a lot of love lately, it was down. Tech, the utilities, which have been doing well, it was down. And really, the least amount of damage was done to staples, the things that you have to have, regardless of what's happening in the economy. And we're keeping an eye on staples right now. This just looks back to the all-time high in January, where energy, even though it was down, it's still been performing the best as far as our sectors. And then we have utilities and staples. These have been doing fairly well in 2022. These are more defensive plays. Then we get over here where we have communication. And this is where, Netflix and a lot of the tech stocks kind of hang out in this sector. And that's why we're seeing it really underperform right now. Here's also tech is having a lot of trouble, and discretionary. And then the banks are kind of taking it on the chin right now. So we have a lot of sectors that really are more negative at least since the all-time high. Here is the tech sector itself. It was down 1.7%. So things are more negative. We're below the moving average and we declined. Here's the SOX index, this is more of an industry group, but these are the semiconductors, and these make up a big part of the tech sector. They were down 2.67%. And it looked like we might have been forming some kind of a base and possibly breaking out to the upside here. Nah, it didn't happen. We just came right back down, but we're back within the range that we've been in before for semis. And you're going to see a lot of this in the charts today. Inflation. The CRB, even though it's in a real strong uptrend, it was only up 0.2%. And then this is the CRB comparing it against the S&P 500. So commodities against stocks. It was up 2.15% with this ratio. It just shows that commodities are doing quite well these days and stocks are really having some trouble. This is an inverse of that same chart that just shows that stocks have really underperformed commodities really since about early 2021. Even though we had that really good year in 2021, this is what we were seeing during that time. And this was on our radar screen saying, wait a minute, commodities are doing pretty good here. Eventually, this could spill over into the stock market. And it did. And that's why we've been having some real trouble in 2022 as far as the nice, clean, always up trends that we've been dealing with. Now, I'm going to include the Fed watch, and I'll talk about that more in the weekly video, but I just wanted to update this because you don't see this very often. This is about as close to certain as you can get. There's a 99.8% chance that at the next Fed meeting, which is on May 4th, and we're getting a little closer to that, so I'm going to start including more of the charts and some of the historical charts. We'll be looking out at further along meetings and so forth. But they say that after that meeting, interest rates are going to be 0.75% to 1%. We're at 0.25% to 0.5% now. So that means it's going to be 50 basis points or 0.5%. And it's almost certain that that is what's going to happen. Now, please, and I keep saying this, but people watch this thinking, what's the Fed going to do? What's the Fed going to do? The Fed is supposed to do what the market tells it to do. And that's really, now it doesn't always work out that way, but that's really how it's supposed to work. And if the market is saying, yeah, we see interest rates going up 50 basis points at the next meeting, that better happen. And if the Fed doesn't do that, that could really cause some problems. And then here's just a historical chart to see how this has changed. And this is all color-coded and all pretty and rainbowish. It just shows this purple line here that back in the beginning of March, nobody was really thinking of that we were going to see a 50 basis point move. That means that the rate will be at 0.75% to 1%. And then it's just skyrocketed up as we've gone through March and then into April. So this just gives us some perspective to look at. A lot of technical alerts. And this is kind of interesting here. The bottom part, that's early in the day. That's when we opened. Those are all nice and bright and shiny green, looking better. Where the top ones, see these things right in inverse order. And all the red ones, those happened as the day went on. I'm really just going to focus on a few here. Where the S&P, we got above 4,500. But later on, we dropped below 4,400 there. And then we saw a lot of good things happening in the NASDAQ. It got above 13.5, 13.6, 13.7, only to do a lot of retracement as the day went on here. The S&P ended up dropping below 4,400. As I mentioned, gold had a bearish MACD crossover. That's been outperforming stocks, but we've seen a lot of fake outs instead of breakouts recently with this. So gold it's not trending really well. And so it's been a real hard thing to get into if you are a trend-based trader or investor, because it's just popping all over the place. And the same thing is kind of true with silver as well. So a lot of positive indications at the beginning of the day are alerts. That's the word I was looking for. And a lot of negative ones as the day kept going on and on and on. Here's the chart. Okay, here we have way over on the right-hand side. We spiked up above R1. We spiked up, even got above R2. And it was really looking like, okay, we're off to the races. The bull market is back. Well, a little bit of selling came in here, no problem. Well, then we just kept going down. We went back down below R1. Then this is the pivot. So we went from being on a positive side of things to negative. And then this dotted line, this is the unchanged level. Well, we just went right through that and just kept going. Little bounce at S2, broke down, little bit of bounce here and there. I tried to calculate S3, but the data just, it's erroneous. And so I'm not sure if we hit S3 down here somewhere or not. But this is really negative overall. We saw a little bit of buying coming into the close, which might have been people shoring up some short positions. But my goodness, this is a massive move. And anytime you look at this, and we ended up being down 1.46%. Or is that 4.8%? It's hard to see that. Here's what it looks like on a bar chart. And really, we've been here before, folks. It looked like we were trying to break out. I was more concerned about some of this resistance. Well, we never even got there. We just came right back down below the pivot, and we're back down to where we were. And that's why we're still seeing a non-trending environment. We're seeing mostly sideways action, even with that monster move that we saw on Thursday. We are now down 8.40% since the all-time high, so we're still not even in correction territory. That's at 10% or more. Now, as I've been saying, there are other indexes that are in correction territory, but we're focused mainly on the S&P itself. This just shows how far we are below the 200 simple moving average. This actually went green for a little while earlier in the day, but no. It ended up going back negative. Growth versus value. This is the battle that keeps going on. We saw a decrease in growth, increase in value. And that's what we're going to see in pretty much all of these charts. Just shows how growth is underperforming. This shows how value is performing better or outperforming. This shows the NASDAQ 100 against the S&P, where the NASDAQ 100 has been underperforming. This shows the pure growth index. It was down 3.17%. Growth stocks were not loved at all on Thursday. We kind of came back up to the moving average here, but just dropped down and closed right near the low. Here's the pure value, where it was down, but not as much. 1.43%. And here's the ratio between the two. And here's another. These are some ETFs showing you growth versus value ratio, where growth is just having a lot of trouble overall. Okay, here's the ADX. It continues to decline, and we're down around 15, a little bit sideways here. It looked like we were getting ready to cross, and it looked like we might have been able to cross positive. Nope. We turned back up with the selling, or the red line, and we went down with the buying, or the green line. And since these lines are still pretty close together, we are still in a trendless environment. We haven't even gotten above the moving average, and we haven't even, after that, gotten above 20 at this point. The Arun trailed off just a little bit. See, this goes back and it sees things that we've been at not too long before, so it's not really reacting to much of anything. There is a decrease in buying. We were flat on selling, according to this. Go figure that one. But it's looking back into all these other days right here as part of its calculation. So we trailed off a little bit with our oscillator, but we're still above zero overall. So that is somewhat positive. Here's the decision point scorecard. Please don't mind the cursor here. It just got stuck in my screenshot there. As far as breadth, we declined based on price. We declined based on volume. You can kind of take that off the table now. The positive divergence that I had been looking at and talking about for the last few days, where even when we saw declines based on price, we were seeing a bit of an advance based on volume. Okay, with Thursday's action, that's pretty much gone now. And then the advanced decline ratio, we're still above zero. That's slightly positive, but we did decline. And then new highs, new lows. Look at this. And on a trending basis, we set a lot of new highs. And because we had such a strong open, and that's when these new highs were set, we spent the rest of the day just going lower. But that has helped the internal side of the new highs, new lows look a little bit better. So we've actually turned up. So this is somewhat positive. It's not an indicator that we base everything on. It's just giving us an insight as to the overall picture of things. Now, this is a little more negative. The accumulation distribution, we finally did drop below the moving average. So we're seeing more selling than buying right now. Short term, we're well below the 20 period moving average. We've declined on the 20, we declined on the 50, and declined on the 200 across the board with our moving average study. Look at this, man. We took a whole trip through the spaghetti factory here. We went all the way up here to the 100-day moving average. That kind of acted as overhead resistance. And then we just doink, 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 just sliced through all of these other moving averages and closed below all of them on Thursday. MACD, negative and declining. Short Swindlin trading oscillator, decline on price, decline on volume. It had been showing some improvement. Now, it is still above zero, so that's positive, but it is declining currently. McClellan oscillator, which had turned positive, it's now back negative. The Stochh RSI, which had been coming out of an extreme oversold condition, well, we're right back down into that now. So this is feeding into the short-term oversold scenario that may produce a bit of a bounce. Same thing with the Williams percent R. We had been coming out of that extreme negative situation only to go right back down inside. And the force index also showed some weakness. It was just about ready to turn positive. Nope. Couldn't have that. Intermediate term, we're below the 50. And this is the red one here is the one that people pay attention to. And we just sliced right through that. We had gotten above it, and that was somewhat positive, but now we're back below. Here's the 100. This is what I was looking at or talking about with the overhead resistance. We hit the upper end of the 100-period simple moving average. And again, I use this moving average more when we're in choppy sideways environments, which is what we've been in. Usually I rely on the 50 and 200 when we're in trending environments. And we dropped below the pivot with this as well. That's also negative. The PMO, which had been showing some improvement, nope. Turning back down now. PMO studies, a decline in those that are rising. We're kind of flat to slightly down with the buy signals. And we're actually going up a little bit with those that are above zero right now. BPI, it looked like it was going to have a nice positive day. It looked like it was starting to move up. Now, on a positive side, you could say, well, this line isn't all that big. The bar is not all that big when we saw such a big down day. Yeah, you could say that. So overall, the BPI, even though it declined, is still hanging in there. It looks a little bit more positive by looking at the longer term chart here. Then I have some more rainbow charts. This is the chart that I usually show with the longer moving averages, where we came right up into the rainbow, where now we're falling out of the underside of the rainbow. Here's shorter. This is from 10 to 50 moving average. And this can be so messy to look at. That's why I don't bring it up all that much. And then these are more intermediate term, 50 to 100 moving averages, where we're down below all of them right now. It looks all pretty and people ooh and ah over this chart, but what's it telling us? Really, it's nice to look at things, but we need to be told something. Stochastics, which had been working off a short-term oversold condition, they're right back there. Turn down more intermediate term. We're still turning up a little bit with the full stochastics. That could be potentially positive, and we're still above 50 right now. The summation index declined just a little bit because the McClellan oscillator was negative, and we declined based on volume. All of our momentum oscillators are negative. I talked about slope yesterday in yesterday's video, and this was really trying to make a turn up. Well, with everything that happened, it's negative. You could say, okay, this is getting extreme negative, but we've gone lower than that before. Vortex. Now try to figure this one out. We saw a decrease in selling and flat buying. Sometimes this indicator is really good and can be really insightful. Other times you look at it and go, what? It's because it's just calculating based on what it sees here. RSI had been slightly positive because we were above 50. Well, in the 14 and the 9, we declined and dropped below 50. Then here's one of the newer indicators, the balance of power. It actually went up a little bit, but is still below this dashed line, so it's negative overall. Here is the Connors RSI. It also showed a decline. And then I brought up the fib retracement here because we've fallen back below the 38.2% retracement level. Different trading systems. Elder with the S&P, red bar, negative, declining MACD. Spiders, red bar, declining MACD, negative. SAR continues to be negative. It never did switch over positive. Chart variations. This is a little more hopeful. We're seeing more almost like a doji look with our Heiken Ashi chart right here. So that we see a little bit of hope in that. Our Kegi, the black means that we're still basically positive because we haven't gone anywhere. Renko, it's still negative. We haven't gone anywhere. 3-line break still looking fairly positive right now. Equi-volume, look at that big, thick red candle right there. Point and figure, no change because we haven't really gone anywhere. Long term, we are below the moving average, the 200-day moving average. We were above it, and that was quite positive. But then as we tanked on Thursday, we dropped back below. And then here's the logarithmic chart as well. The mega caps, they were down almost 2% and just showing a lot of weakness right now. The Special K longer term oscillator for helping us determine the trend continues to decline. And it takes a lot for that to move. Our moving average study based on the 50 decline, 150 decline, 200 decline. But you could see some positive here and that we're still above these midpoints right here. So that's slightly positive. Broad market. Here's the S&P right back down into the range where we were not so long ago. The mid caps look like they were breaking out. They fell back. You could say, well, I'm seeing a series of higher highs and higher lows right here. Well, that'd be a stretch, but you could say that. You could also say that with the small caps. And we've been keeping an eye on the small caps, and they did not as bad on Thursday, so we'll wait until we get to that chart. This is the Dow Jones Composite. Taking the Dow, the trannies, and the utilities together, it was down 0.87. And they're still positive because they're still above the moving averages. But you can see where the moving averages are almost on top of each other. That just shows there's really no trend at all. Dow theory, decline in the Dow, little bit of a decline in the trannies, which had been seeing recent weakness big time, and decline in the utilities, which had been performing quite well. I include the utilities as part of Dow theory, but other people just look at the Dow and the transports. Here's the FANG stocks, taken out and shot, down 2.79%. ARC Innovation, taken out and shot, almost 5% decline. It really looked like this was starting to break out, but no, it's been seeing a lot of recent weakness lately. And the Dow itself, this is a little more positive. We're above the pivot. Yes, we fell below the 200, and that is quite negative. But we've been in more of a range right now with the Dow itself. And then here's the diamonds, back to neutral, where some of our other elder signals are red. This is blue, which means it's neutral. Here's small caps. They were down 1.58%. And again, it looked like these things were trying to break out, but we fell back below the pivot and the 50-period moving average. So yeah, you could say there's higher highs and higher lows here, but we're going to need to see more than just what we see right now. with the small caps. Here's the mid caps, kind of right in between. We broke above the 200-day moving average, only to come back down, but we're still above the 50-period moving average. However, we drop below the pivot. So twist this around any way you want. NASDAQ came right up to the 200, fell back down, closed at the low. We've actually broken below this range right now, but we've been in this territory previously before. NASDAQ 100, kind of the same thing. A lot more weakness seen with the tech, in the tech areas. Here's the Vixen, where we saw the decline in the NASDAQ 100, so we saw a real spike up in the VIX of the NASDAQ 100, which they call the Vixen. Just love that name. And the Qs, they're negative with a red bar and a declining MACD. NYSE, little more hope here. We're still above the pivot. We're still above the 50. However, we came back down below the 200. But this is more sideways action, and this is a broader based index. S&P 100 actually outperformed the rest of the S&P on Thursday. And then here's the Wilshire, another broad base that we look at. This is a little more negative because we dropped below the 50 and we're below the pivot. So the NYSE is holding up a little better, where the Wilshire is looking a little more concerning, but we're still in this range that we've been in. As far as all stocks, we've seen pretty much across the globe weakness right now as the world deals with this inflation and interest rate issue. All stocks, they were down 1.55% and below the moving averages currently. This didn't update, but I didn't want to delete this because I include this as one of my regular charts. So we kind of have to skip over this one. And the dollar, it was up. We're still above 100 right now. And here's the weekly chart as well, showing a nice solid uptrend for the dollar. Here's oil. It was up 1.5% to 103.79. And here's gold. It was down 0.33% on the futures contract, and pretty much the same, down a little over 0.33% with the ETF. And here is the longer term view. Silver just got hammered. There's a joke in there somewhere. We were down over 2% right here with the silver ETF and dropped below the 50. And then here's a longer term view of that same chart, which it had been holding up a little bit better, but not very good. Bitcoin, which had been in the high 30s, got into the 40s. It was up a little bit. We're into the 42s now. As far as bonds, this is the first yield curve that went inverted. This is the same chart that I showed yesterday, where we came up a little bit, but we are still negative overall. Actually, we declined on this chart a little. And then here is the 30 to the 5. It's just barely. It's 0.02 negative right now. But now we have two yield curves that are inverted. Here is the fib levels, where we're right at about 2.94%. We've broken above the 61.8% retracement level with the 30-year yield. And then here we're seeing a bunching up, especially in some of the longer term bonds, but a real increase in interest rates nonetheless. Internationally, also seeing a real spike up in interest rates. Bonds, based on price, continue to show weakness and have broken big time support. Now we're going to have to see, are we going to hit any support going back here to 2008? I mean, this is a long-term chart here. And then corporate bonds also saw some weakness, and the current yield is at 3.87%, still well under inflation rates. Junk bonds were down. They usually follow stocks, and the current yield is 6.34, also well under the current inflation rate. And then here, this is the junk bond to regular bond, or TLT, government bond ratio. It declined a little bit. And I just like to see which one's performing better as we go over time. And junk bonds have been outperforming lately. It's not hard to outperform the bond prices these days. But with the weakness that we saw, this declined a little bit on Thursday. Some of our relative studies, gold is it was up a little over 1% with the ratio and we're still up overall, but we've been faked out with this before. And where energy, it actually declined, but is in a more solid uptrend. Here's the energy against tech, where we just see energy had a down day, not quite as bad as tech. So this ratio declined a bit, but it just shows that energy has really outperformed. This is showing where growth in bond prices, which is not hard to do because that's why we've seen a lot of sideways movement here, because both are very weak. Growth stocks have been having trouble and bond prices have been having trouble. And then looking tech in the S&P continues to underperform. And then tech to the 10-year just shows how interest rates have really outperformed tech. And then here's our correlation. We're losing that a little bit. We're not seeing the close to a 1 to -1 relationship or inverse, where the dotted line are interest rates and the black line is the tech sector. There's still a strong relationship there, but it's not as strong as it had been. And then here's the 10-year yield to tech, just showing that interest rates have really outperformed tech. As well, here's discretionary, things that you don't have to have against staples, things that you do have to have. Discretionary continues to show weakness, which is suggesting more of an economic slowdown. And here is the S&P, which has really been having trouble as interest rates are going up. The low volatility stocks, they were down 0.5%. So yeah, they were down, but not as much as the rest of the market. And they've been holding up better when you compare them to the SPY. Then this is the one I've been trying to point out, where sometimes when we see a spike up in the small caps, which is the red line here, not long after that, we can see a real spike up with the S&P. And it looked like, okay, let's keep an eye on this. Well, it declined a little bit, but we still want to keep an eye on this, just in case. And then this is another thing where we have staples at the bottom and the S&P at the top. And when staples have topped out, a lot of times that marks a bottom with the S&P. But we don't really know. See how this thing just keeps going higher and higher and higher? It's almost into the question mark now. I'm going to have to move that. So we don't know when that's going to end. Okay, so what is our outlook for Friday? Yes, our technicals are negative. The improvements that I was talking about are not really there now. The markets remain in this intermediate term trendless range that we've been in pretty much for all of 2022. The value growth battle continues. We still have supply chain issues. On Friday, we get the preliminary IHS Market Manufacturing Services PMIs. Those are pretty important. So this is the preliminary reading. So the market may react to that. And then, of course, we have the whole Russia-Ukraine situation, the supply chain issues and what's going on in China with the continuation of the lockdowns, inflation and interest rates, which that's kind of at the forefront right now. Oil prices can have an impact. Earnings that are coming out with different companies. Thought it was going to be a good day. Thank you, Tesla. But then things turn negative after that. And then if things come out from the Fed that the market reads secret meaning into, that can cause a lot of gyrations these days, especially as we get closer to the next Fed meeting or FOMC meeting. So what are our scenarios for things to keep going down from here? Well, let me back up. The scenario that we're in right now is this yellow one. We are in a trendless sideways pattern. The ADX is below 20 and continues to decline. So this produces a real slowdown. Laugh at that with the big move that we saw on Thursday. I'm talking about looking at bar after bar after bar, not necessarily intraday movement. And it's a real slowdown in movement and very choppy. We're pretty much going sideways overall. That's the scenario that we're in right now. What's going to happen for us to go down from here? Rising interest rates. That's having a real impact. Inflation fears. Some bad earnings report comes out. And I didn't put it on here, but more Fed speak that spooks the markets. The technicals are negative, and you can make a case now that we are short-term oversold. So we might see a little bit of a bounce from there. What's it going to take for us to go up from here? We still have that positive backdrop after the yield curves reinvert. Well, they've gone inverted again. So this isn't really a viable scenario right now. And then the staples spiking. Well, they continue to spike. So this scenario doesn't seem all that likely right now, other than if we get a short-term bounce from being oversold. The technicals, the moving averages, we're just cutting through them. And some of the pivots, we've been breaking through some pivot levels and holding up some other pivot levels. They may provide either support or resistance as we're going about with things. So what's our conclusion? The S&P is negative. And short term, negative, but oversold. Intermediate term, negative, all of our oscillators. And we're below all the moving averages. All of those are negative right now. Long term, since we're below the 200-day simple moving average, we continue to be negative. Then here's just a list of the other available videos. I will prepare another daily video after Friday's session. I have a pretty busy couple of days coming up, so I might be a bit later with how I post things. And then I'll be doing a weekly video over the weekend as well. So thank you. Have a wonderful Friday, and I will prepare the next video and post it just as soon as possible.